So, welcome to Crowding Out. This is a highly contentious area, and many on the right really like this concept of crowding out. So first of all, we're going to look at what we mean by resource crowding out, then financial crowding out, and then we're going to look at some of the implications and criticisms of this concept. This concept is really quite simple. It's simply this, that the opportunity cost of increasing the size of the public sector is a smaller private sector. There's only a limited level of resources in the economy, such as labour and capital. So if the government takes more of the national cake, then there's going to be less left for the private sector. So as a proportion of GDP, the private sector will be smaller. And guess what? We can illustrate that with this marvellous cupcake here. So imagine a quarter of it is public sector, 3/4 of it is private sector. So if we just take a bit off, okay, and we'll eat that later, then what's left? Only half the cake left now for the private sector, because the public sector has gobbled up the other bit. So it's not a really hard concept, is it? So we can illustrate this with a PPF diagram. If we've got our output here, potential output, if the public sector gets bigger, we go from PU1 to PU2, then the private sector will get smaller. It'll have a smaller share of the national cake, a smaller share of resources. Okay, so we shift from A to B. And this has big implications. The implications being that the private sector is the bit of the economy that is efficient. Not that like that inefficient public sector. It's efficient, it's wealth creating. And what free market economists mean by that is that it produces exports, it has the profit motive, there's often competition, which means they use resources efficiently and effectively. So this results really in a higher level of productivity in the economy. But if you reduce the size of this sector in the economy, productivity will tend to fall. We'll come back to that later. Let's just look at another type of crowding out. What we assumed about resource crowding out is that government expenditure would increase and taxation would go up. So we're not changing the budget deficit of a budget surplus, the budgetary stance staying neutral. So to pay for more government expenditure, tax revenue goes up, and that's why we eat up more of the public slice of the cake with an increased public sector. There's another type of crowding out which can occur, which is basically called financial crowding out, and that's the idea that you increase the government sector by increasing borrowing. So if the government borrows more, what happens? Well, a similar story according to those that advocate crowding out, which is that if the government increases investment in capital projects, it needs to borrow. So it will increase the demand for loanable funds. It will increase the demand for funds from investment markets, money markets. And so if there's more demand for something, that tends to increase the interest rate. Interest rates tend to go up, and therefore high interest rates mean that there'll be less private sector investment. Okay, so an increase in government investment then crowds out private sector investment. Extreme crowding out, free market economists tend to think it happens one-to-one. But of course, a key point to consider is, are those loanable funds so finite? If they come from abroad in a globalised financial markets, will it necessarily have this effect? And will it be a very significant effect? Will it actually increase interest rates? So I'll leave it to you to ponder that question. So we come back, we've got crowding out, two forms of crowding out. And the argument being that it will reduce the wealth creating aspect of the economy, it will reduce investment by the private sector, and therefore it's likely to lead to a lower trend rate of growth if we significantly increase the size of the government sector, because private sector investment is assumed to be more efficient than government investment, okay? Because that suffers from government failure. We won't talk about market failure, but let's consider that if there's less investment in the private sector, productivity will increase at a lower rate, because we have less research and development, fewer innovations, fewer new products, less business expansion. Productivity is increasing at a lower rate. The trend rate of growth will tend to increase at a lower rate in the long run. And therefore, in the long run, standards of living will increase less quickly. This brings us to the point of equity. What will happen to inequality in society? And it may be that if we make the private sector bigger and we reduce redistributive taxation like income tax, it's possible that inequality might increase. Also remember that the public sector provides goods that create a more equal society, such as the welfare state and providing infrastructure, etc., which helps all in society. However, a key criticism, two criticisms from a Keynesian point of view. Firstly, the public sector provides useful, essential goods and services for the private sector, which enable private sector growth. First of all, we provide public goods, such as law and order and defence, which provide security. Public sector provides infrastructure, such as roads, railways, telecommunications, airports. These are all essential for private sector growth and development. The two go hand in hand. And of course, education and training being a particular merit good and education that enables the private sector to expand and increases productivity in the economy if you look at the video on supply side policies. So this is a counter-argument to private sector good, public sector bad in terms of productivity. And there's one further argument. Will crowding out actually occur? Because if we've got spare capacity in the economy, then what will happen? If we start at point C, which is within the PPF, and there's spare capacity there, idle labour and capital, and the government increases public sector spending, investment, then this will have a positive multiplier effect. So if we increase, say, public sector spending by 10 billion, okay, then we'll move from PU1 to PU2. But what will happen is there'll be a multiplier effect, and then this bit will be private sector expansion as a consequence, as we move from PR1 to PR2. So that shows that in a recession, or when we've got spare capacity in the economy, then certainly crowding out is not likely to occur, according to this Keynesian analysis. Okay, so I hope that is useful. Thank you for watching.